So thank you so much for joining the webinar today. It's really good to see you all. My name's Peter Webb and I'm Head of Tax Advisory for the Fry Group. So today what we're going to learn is what Rishi Sunak's recent budget statement actually means for us all. Now what I'll say before we get too stuck into this is please do not take any action on the basis of this webinar alone without seeking specific advice for your personal circumstances. And just a couple of housekeeping points to make you aware of. Firstly, please do ask questions as we go through the presentation. You can do that by using the Q&A button. I'm going to try and get to as many of those questions as I can at the end of the presentation, so we'll leave some time for that. And secondly, if you'd like a copy of today's slides, you're able to request those from us, and I'll pop up a slide at the end with our contact details to allow you to make contact with us. Okay, so our agenda today. So these are the points we're going to cover. I think one of the most interesting and possibly alarming is what will change in the future. So let's get straight on with the presentation. So Rishi Sunak's budget had the stated aims of protecting people's lives and protecting livelihoods. And that's coming at a huge financial cost. Government borrowing this year is going to be, it will reach maybe £2.1 trillion. That's around just over £30,000 for every single person in the UK. Government borrowing will increase perhaps by £400 billion to pay for the pandemic. What's the money being spent on? Perhaps £100 billion is being spent on support for jobs, such as the Furlough Scheme, where the government steps in to pay most of a worker's wages, for example. The NHS, other public services have been given significant amounts of extra money to pay for the costs of fighting the pandemic. Now, leaving aside the human costs and personal impact of coronavirus, I think it's fair to say the pandemic is the biggest challenge to government finances that we've faced maybe in a generation. And Rishi Sunak stressed the profound damage, these were his words, profound damage done to the economy. And he vowed to do whatever it takes to help the economy recover. So you're going to have a chance to ask me questions at the end of the presentation. I actually have a question for you. So the question that's going to pop up on your screens right now is, when do you think we're going to be free of COVID? And I've got some multiple choices there. So I'll give you a chance just to answer that. So by the end of this year, end of that next year, never. Be interesting to see what you say. Okay, I can see lots and lots of you are voting, so I do just give you a few more seconds for that. Okay, I think we're pretty much there. So let's see what you thought. So those answers should be coming up. Oh, goodness me. Yeah, so half of you, 50%, think that we'll never be free of COVID. Goodness me. 43% are going for the end of next year, end of 2022. And 8% of you, only 8%, think that we're going to get out of this by the end of this year. That is quite astonishing, isn't it? Okay, so let's start thinking about the impact of the budget statement for individuals. So I think the first thing we'll say is that furlough scheme. So that furlough scheme has been extended until the 30th of September. It was due to expire at the end of April. It started way back last March when the crisis first began. So wages for millions who are unable to work due to the restrictions will continue to have up to 80% of their salary subsidised by the government, and that's a maximum of £2,500 a month. Now, the relief will gradually be lifted. So the government reduces its contribution to 70% from July, and employers have to make up that 10% for hours not worked. In August, that ratio slips down again, so 60% for the government, 20% for employers. Do you think about that furlough scheme? It's quite astonishing. About 4.7 million people in the UK are currently on furlough, and about 1.2 million of those work in the hospitality industry. So a further 600,000 people who are self-employed have previously been excluded from support measures, but now they will be able to claim some support. And what we're going to see is that maybe 80% of 3 months average trading profits up to £7,500 is going to be the relief available. But people who don't qualify may be eligible for a one-off grant. And now we actually have some figures for the 2019-20 tax year, because you've all submitted your tax returns on time. Then it's going to bring in more people who can meet the criteria to qualify for that self-employed support. So these announcements had been trailed quite heavily, and they really didn't come as too much of a surprise. The hospitality industry has lobbied for a freeze on alcohol duties. Fuel duty is a really interesting one. So fuel duty has been frozen. The last time that actually rose was 2010. Most commentators agree now is not the time to be raising fuel duty, but there's a really big word of warning that goes with fuel duty. It has enormous potential to generate tax revenue for the government in the future. And it allows, a raise in fuel duty allows the tax burden to be increased without headlines of rates of income tax, capital gains tax, VAT, for example, being raised. So I think the first thing I would say on this slide is that Rishi Sunak is sticking with that Conservative manifesto where they pledged that there would be no increases, no changes to the rates of income tax, national insurance, or VAT. We're not seeing that in this budget. The personal allowance, that tax-free amount that you can earn without paying any income tax, that's going to increase to £12,570 for next year, the 2021-22 tax year. It's £12,500 at the moment. And the basic rate tax band is going to be increased to £37,700. Now, income falling within that basic rate tax band is only taxed at 20%. The higher rate threshold, where you start paying tax at 40%, that's going to be increased to £50,270 from the £50,000 that it is now. But those thresholds, those bands are going to be frozen until the 25-26 tax year. Now, what that means is we expect that perhaps 1.3 million more people will then pay income tax, with a further 1 million people will be brought into paying tax at that 40% rate who don't pay tax at 40% now. These two moves are expected to cost taxpayers, by the way, that's you and me, around about £8 billion a year up until 25-26. The question I would ask is, are those with the broadest shoulders bearing the greatest burden? Is the increase in taxation being targeted at those most able to afford it? So I did a really rough calculation, and it's based on a really ambitious inflationary rise of 2% in income each year. And I did that until 25-26. So based on my really rough calculations, someone with taxable income of £200,000 today will see the amount of tax they pay by 25-26 increased by 10%. So the amount of tax they pay will be increased by 10%. Now, someone with taxable income today of £13,000 will see the amount of tax they pay increase by 350% by the time we get to 25-26. So Rishi Sunak insisted it is fair and responsible to ask people earning higher wages to pay more. I make no other comment than that. So the stamp duty land tax holiday for England and Northern Ireland extends that stamp duty land tax nil rate band to £500,000. That was originally due to expire on 31st of March 2021, but again, heavily trailed before the budget, and that allowance is now extended until 30th of June 2021. And then between June and September, that allowance, that nil rate band is reduced to £250,000, and then it drops down to the usual rate of £125,000. That's the rate it was sitting at before we had the extension to £500,000. Okay, so I think this is one of the really interesting things in the budget, is what is not changing. So the lifetime allowance for pensions will remain at the current level of just over £1 million until April 2026. Typically, that lifetime allowance increases with the rate of inflation each tax year, but that's not going to happen. And that freeze alone is expected to raise a total of £1 billion for the Treasury. Generally speaking, if your pension fund is valued higher than that lifetime allowance, HM revenue tax the excess at 55% if the pension is taken as a lump sum, or 25% if it's taken as income over and above the tax you would normally pay. Another thing that doesn't change, the allowance for tax relievable pension contributions you can make each year, that's been frozen until April 2026. The thresholds for main residence nil rate band for inheritance tax, I can give you a further exemption, maybe up to £175,000. Again, frozen, not rising with inflation, and frozen until 25-26. The capital gains annual exemption, that exempts the first £12,300 of gains that you make in a year. Again, frozen at £12,300 until 25-26, no inflationary increase. Again, and those steps are going to gather perhaps another £1 billion for the revenue. VAT. The VAT registration threshold, again, will not rise, not until 31st of March 24. And that brings even more sole traders and companies into the complex VAT reporting and payment regime. So by not raising allowances or tax bands, Rishi Sunak is increasing the tax we pay without raising those headline rates of tax. And you may see that as really quite a stealthy way to raise taxes. Okay. So these are announcements that have been made previously in the last budget before this one. And it's worth just reflecting on these because there are some changes here that are going to affect you really quite shortly. So I think the first one we'll just mention here is something called IR35. And if this affects you, you will know what IR35 is. So IR35 is a piece of legislation, an anti-avoidance measure, to make sure that if you are being treated like an employee, that you're going to be taxed as an employee, rather than saying that you're some kind of self-employed consultant and getting a tax advantage by doing that. So from 6th of April 21, the responsibility for assessing whether or not somebody working for you is an employee will become the responsibility of the company, the entity that services are being provided to. Now, if that entity decides the person providing services to them is in effect an employee, no matter what they're calling themselves, then that entity will then be responsible for deducting income tax and national insurance contributions from the payments made for their services under the PAYE system. We're going to see the biggest impact on this where people perhaps have a consultancy role. Perhaps they're thinking of themselves as a self-employed consultant, whereas actually these changes in the law will treat them as though they were genuinely employees of the company or entity they are providing services to. Now, previously, these rules generally applied pretty much to the public sector. But from 6th of April 21, the rules are extended considerably, and it's going to bring many more entities, companies, within the scope of these rules. Moving on, I think another really good thing to mention, something to be aware of, is the change in rules for stamp duty land tax. Now, we've talked through the extension of that nil rate band until the end of June, but actually there's a rule that was announced in the last budget before this one, and it kicks in from 1st of April 21. And from 1st of April 21, if you are non-UK tax resident and you're purchasing a property in England or Northern Ireland, you're going to pay an additional 2% stamp duty land tax surcharge. So why don't we put some numbers on that to see what that actually looks like? So we have somebody who is UK tax resident and they're purchasing their first home and it's costing them £500,000. And they're doing this on the 2nd of April 21. So UK tax resident, first home, purchasing on 2nd of April 21, costs £500,000, they will not be paying any stamp duty land tax at all. How about a non-resident who's buying an additional property on that day? So 2nd of April, non-UK tax resident buying an additional property for £500,000, they're going to pay £25,000 in stamp duty land tax to buy that very same property. Okay, we'll move on. So we're going to consider changes that are more specific to businesses, so sole traders, partnerships and companies. And some of these reliefs are a little bit detailed. And I think some of them are actually really quite welcome. If I can say this, get my teeth in, the Institute of Chartered Accountants in England and Wales, the ICAEW. Now, they recently surveyed their clients and they found that just 1 in 4 of their members said that their clients in hospitality and leisure would be able to pay their business rates in full at the end of March. Put that round another way, 3/4 of businesses in the hospitality and leisure industry are unlikely to be able to pay the full amount of business rates due at the end of March. So it's a very welcome relief. The VAT cut to 5% for hospitality, tourism businesses, that's also going to remain until September. And after that, it's going to increase to 12.5% before returning to 20% in April 2022. So I wonder if that gives us a bit of a pointer as to when the government think we're going to be out of the effects, at least financially, of the coronavirus. They're looking at April 2022 to bring in that full rate of VAT. So the freezing duty rates for beer, cider, wine, spirits, we just briefly mentioned that. That's going to help some of the hardest hit sectors. And I find this next statistic really quite astonishing. So in the UK, around 10,000 licensed premises, that's 10,000 licensed premises, so pubs, clubs, restaurants, have closed permanently. They won't be reopening last year because of the coronavirus. So there are some grant schemes that have been announced. A £5 billion grant scheme for England to help high street businesses reopen after lockdown. About 700,000 businesses will be eligible for the grant. Shops, salons, gyms, restaurants. There are some retail that opens earlier. Grants for those businesses maybe £6,000 each. Hospitality businesses are likely to open later, and those individual businesses could see a grant of maybe as much as £18,000 each. Okay, so I think this is where we really did see some big tax changes in the budget statement. So UK corporation tax on large company profits. So large company profits, that's over £250,000. They're going to rise from 19% to 25% in 2023. That had been trailed a little bit, that corporation tax was actually going to rise, but we perhaps had a figure of 23% in mind. So if there was a surprise in the budget, I think it was the extent of the rise on corporation tax. There's a little bit of detail here. So the corporation tax rate on small company profits of less than £50,000 will remain at 19%. But this is where the devil in the detail lies, because that 19% rate is for actively trading companies only. So in terms of the clients that I speak to on a daily basis, many of them actually have a company that holds investment properties. So you've put your buy-to-let properties into a company, and that company holds those buy-to-let properties for you as an investment. Now, if that's you, that company is not going to benefit from that 19% corporation tax rate at all. You're going to be paying corporation tax at 25% on all profits with a company with an investment business. It's a very common conversation I have. I'm interested in purchasing buy-to-let properties. Should I hold them in my own name, or should I hold them through a company? I would say maybe 8 times out of 10, holding them through a company is not the right tax solution. And I think with a 25% corporation tax rate, that's going to change the conversation yet again. Now, trading companies with profits between £50,000 to £250,000, they're going to be provided with some marginal tax relief to assist with the gradual increase in corporation tax rates between the small profits rate and the main tax rate. In terms of raising tax revenue, these changes are going to provide perhaps £46 billion of tax revenue over the next 5 years. It is a steeper tax hike than was expected, that's for certain. A point that Rishi Sunak stressed in his statement was that the UK corporate tax main rate will still be the lowest of the G7 economies. I'm talking to you today from Singapore, but it does mean I think that the view that the UK is going to be Singapore on Thames is much less likely now. And just to put some context on corporation tax rises, so last time we had a corporation tax rise, a rise in the rate, ABBA had just won Eurovision, George Foreman and Muhammad Ali had just had the Rumble in the Jungle, and Richard Nixon had just resigned. If you're wondering what year that was 1974, the last time that corporation tax rates actually rose. Okay, so some more detail around those businesses. So there's going to be this super deduction. A tax break for companies will be introduced. It's going to apply for investments into productivity enhancing plant and machinery. What it comes down to is that for every £100,000 a company invests in qualifying plant and machinery, they're going to be able to reduce their corporation tax bill by £25,000, to put some real numbers on that for you. Another thing that's going to happen is that we're going to see an extension of the carryback provisions for trading losses. That's very, very welcome. Many businesses have been suffering during the current pandemic, and they'll be able to carry those losses back. Usually you can only carry back losses for 1 year. Now we're going to have an extension, perhaps up to 3 years, where you can actually carry losses back to set off against previous profits that the companies have made. Okay, so we're going to move on and think about some future tax changes. So Rishi Sunak said tax rises were also needed to help repair public finances. I'm just going to say that again. Tax rises were also needed to help repair the public finances. I think that really is a clear signpost amongst many that there are tax rises to come in the future. So I think a couple of things were really interesting. In many ways, the interesting things in this budget were the things that were not announced, the things that we were expecting to be talked about. And there's been no mention of the overhaul of what is a really outdated regime, that inheritance tax regime. And there's not been any increase in capital gains tax. One thing that we are expecting perhaps at some point is that capital gains tax rates will once again be aligned with those rates of income tax. So capital gains tax rates at the moment, they start at 10%, 20%, 18%, 28%. Income tax rates, 20%, 40%, 45%. And the government has actually requested the Office of Tax Simplification to report on both reforming inheritance tax and capital gains tax. And that word reforming, I think, is a little bit of code. I think what they're asking for is how can they be simplified? How can reliefs be taken away? How can the rates, the effective tax take from inheritance tax and capital gains tax, how could that be increased? I think to make a really simple point on this slide is that the government at the moment is spending far more than they are collecting in taxes. And that will certainly change. They are certainly going to look to close that gap between what they're spending and what they're recovering in tax. Okay, thank you for bearing with me this far. We're actually moving on. We're getting to our key takeaways for today. And I think they really are quite interesting. So, well, interesting, maybe alarming even. The freeze in allowances and tax bans does mean that in real terms, the tax that you pay is going to increase. There's been a really clear signpost that there will be increases in taxes in the future. And that's not at all unexpected. And that stamp duty land tax holiday, that's a really welcome extension for that to continue until 30th of June 2021. So in a moment, you're going to be able to ask me lots of questions, but in the meantime, I actually have another question for you. So that question, which will probably be popping up on your screen right now, is how concerned are you by the prospect of future tax changes? And you've got three choices there: not at all concerned, somewhat concerned, and very concerned. So I'm going to let you have a little bit of time to have a little bit of a think of that question and pop your answers in now. Okay, I can see lots and lots of you are voting. I'll just give you a few more seconds to do that. Okay, all right. So perhaps we'll close the polling there and see how we did. Okay, yes. So not at all concerned is a tiny minority of you. That's 6%. Somewhat concerned, 55%. That's the majority. Perhaps, you know, that's a fair comment to make. Very concerned, 39% of you are actually very concerned about what the future may hold for tax rises. Okay. All right, so why don't we try and get to some of those questions that you've actually been asking me. So let's have a look and see if I can have a look at that for you. So do you expect stamp duty surcharge change to apply to purchases in Scotland as well? So yes, we would expect those to be reflected in Scotland too, but we will wait and see on that one. Okay, thank you. So next question. This is a fantastic question, actually. Will there be a wealth tax? Oh, goodness me, that's been a big discussion really over the last few months. Will the government actually bring in a wealth tax? It's a really, really tough thing to do. Off the top of my head, I think they have done that in Argentina. But it's such a hard thing to police. There used to be a wealth tax in some European jurisdictions, and they backed away from that. Rishi Sunak has gone on record as saying he doesn't think a wealth tax is actually fit for purpose. So I think we've got a clear indication that in the life of this Parliament, I think it's unlikely that we are going to see some kind of a wealth tax. Thank you for that one. Okay, so how will capital gains taxes change? Well, again, a great question. So we're gazing into that crystal ball of the future with this one. Let's have a little bit of a think about that. So when I first started in tax, which is far too many years ago, capital gains tax rates were the same as income tax rates. Capital gains tax rates at the moment are at historic lows. So we've got a bottom rate of 10%, 10%, 20%, 18%, 28%, mentioned those earlier. So I think a very easy thing for the government to do would be to increase those rates so they actually match income tax. That wouldn't be unexpected. I don't have any knowledge on that, but that would seem a pretty obvious route to take. The other way that capital gains tax could actually change is that they could actually take away some of the allowances that we see available now. So this time last year, we were talking about the removal of entrepreneurs relief. Entrepreneurs relief actually gave you a 10% rate on the first £10 million of qualifying gain from selling assets in a business or a business. That was actually reduced to £1 million. And we do know the government have said that they don't feel that the entrepreneurs relief, they now call it business asset disposal relief, they don't feel that's fit for purpose. We saw it reduced by 90% last year. It's now £1 million. Could that relief simply disappear? It's not unexpected to see that go, or at least be reduced again further. And again, you have that capital gains tax annual exemption, £12,300. You can make £12,300 of gains each year and not pay any tax. It wouldn't be unexpected for that allowance to be reduced or even removed completely. There is a perception, whether rightly or wrongly, that actually it's only the wealthiest people who pay capital gains tax. So changes to capital gains tax are only really affecting the wealthiest in society. That's the perception. Whether that's reality or not is a different matter. Okay, next question. what can I do to protect myself from increased tax in the future? Oh, goodness me, that's a really, really wide open question. I think the first thing to do is to sit down with a tax advisor and perhaps even a financial planner as well, and have a look through your asset base, have a look through the investments that you have, and just see where the highest exposures to tax actually are, and whether there is preemptive action that you could take by perhaps putting some investments into structures that we feel would be protected from future tax changes, or even taking gains out of investments now. Well, perhaps you may still be able to do that while you're exposed to perhaps lower rates of tax than you may be in the future. That's going to be a very, very individual discussion that you're going to have, which is very bespoke to you with a tax advisor and a financial planner. I think what I would say is that it's really on the cards that there are tax rises on the way. It's really not going to be unexpected to see that in a couple of years' time, we're going to see tax rates which are higher than they are now. And perhaps it is time to take stock a little bit, just see where that exposure to tax is and see if there is anything that we can suggest, or a tax advisor or a financial planner could suggest that would help you. But yes, preemptive action may be something to consider. Okay, another question. Was there anything in the budget specifically for expats? There was one announcement which I don't really have too much detail on, which I did see, which is really not a kind of a tax point. And that is that I think provided you qualify, there are some expats who will be allowed to vote in UK elections. I know that was a bit of an issue around the Brexit, the whole referendum, but there were some changes announced. So it's worth having a little bit of a Google of those, see if you can find out what those changes are. I paid little attention because it wasn't a tax thing, but I did notice that. And of course, watch out for that 1st of April change for stamp duty land tax for England and Wales on that 2% surcharge if somebody purchasing a UK residential property is a non-tax resident. Okay, another question. Actually, another couple of questions have popped up. Do you think it's possible that you could see the removal of personal allowances for non-UK tax residents? That's not impossible to see at all. Yeah, that could be a change. That could well be a change. We will, yeah, I don't, that hasn't actually been mentioned much in the press at all. Actually, I'm struggling to think of any time that that's been mentioned. But it would be a very easy change to make, that if you're a non-tax resident, you don't get a personal allowance. Oh, okay, I mentioned the giving expats the right to vote. Do we think giving expats the vote is a sign they will start taxing them? Okay, so great question from an anonymous attendee. If you're non-tax resident, your liability to income tax in the UK is UK sources of income only, capital gains tax, generally the disposal of UK land and property. Giving expats the right to vote, is that sort of the foot in the door to widen that open to increase the liability for UK tax non-residents? We'll wait and see. I guess anything's possible. There is a very large gap between what the government is spending and the debt they're building up now and the tax they're collecting. So that has to change somehow or another. So how about probable changes to inheritance tax? It seems quite simple to me now. Maybe it's me that is simple. Is the Chancellor just talking about simplifying it? Did I understand you right? So what has happened with inheritance tax is that the government asked the Office of Tax Simplification to provide a report on how they would see inheritance tax being simplified. But I think there is an underlying agenda there, that inheritance tax, actually, that they could increase the amount of inheritance tax that is paid. It's not one of those taxes that's protected in the Conservative manifesto when they launched their election manifesto. So what we saw from the Office of Tax Simplification is perhaps by simplifying what they're doing is perhaps taking away some really valuable inheritance tax reliefs. They are complex, but if you can stay within the guidelines for them, you get a big advantage. So simplifying could mean just taking away some reliefs that are available to you. Perhaps, yeah, inheritance tax is a very, very personal thing. Some people have extremely simple inheritance tax. Some people have much more complicated scenarios to work through. So, yeah, it's an interesting question. Okay, let's have a look and see if we can pick up on some more questions. Are there rumoured changes to the Seed Enterprise Investment Scheme and the Enterprise Investment Scheme? So Seed Enterprise Investment Scheme, Enterprise Investment Scheme, these are really, really interesting tax advantaged investments that you can make. They are advantaged for inheritance tax, income tax, and capital gains tax. You really need to speak to an independent financial advisor to get advice on these. I can talk you through the tax implications for investing, but you do need to ask the question, are these the right things for you to be investing in? But what I would say is there were no real announcements in the budget on this. Rates stay the same, allowances stay the same on these, and I haven't heard rumour that these are actually going to change. Given that the government is going to want to encourage investment into small businesses, which is what these schemes are about, then I really wouldn't see these being taken away, at least in the short term, that's for sure. Okay, any other questions? No, I think that's really it. I think we've done really well on the questions, actually. So thank you very much for asking some great questions. Apologies if I didn't answer them quite as fully as you would want me to. You'll appreciate that if you do want to follow up with some really specific questions, I will pop some email details for you to enable you to do that. Okay. So a little bit about the Fry Group. So I know that many of you will be familiar with the Fry Group, but for those of you who don't know who we are, don't know about us, a very short introduction. So we were established more than 120 years ago. Since then, we've helped thousands of people around the world and across the generations. And today we have 8 offices around the world. I'm speaking to you from our Singapore. Well, I'm speaking to you from Singapore. I'm actually working from home. So we can offer a truly global perspective. Our services cover 3 core areas of financial planning: tax, estates, investments. Our teams work together across these 3 areas and across countries to create the right balance for each client. So our core purpose is to create financial freedom for our clients. We understand that means different things to different people, so we take time to find out what is important to you so we can structure your finances around your goals. Okay, so if you would like to contact us, perhaps ask us a question, request a copy of the slides, these are the contact details to allow you to do that. Let's leave those up for a second. We might come back to those. But thank you very much for attending today. It's been great to have your company on the webinar. I hope you found it useful. And just a little disclaimer for you. So I would reiterate actually that please don't take any action on the basis of this presentation alone without seeking some specific advice for your personal circumstances. And we'll just go back and leave you with our contact details. So thank you so much for your time today. That's very much appreciated.